This is the normal course of how money is raised. Hey everyone, and welcome to Module 5 of the Future Founders Conference. This is Ankur Warikoo, and today's module is on fundraising. It's the most popular concept and the most popular module in the entire 8-module series. There's a lot of expectations that people have from it, so we're going to have a lot of fun. So let's get started. We have a lot to cover. For those who may not be so good with math or fear it, please don't feel intimidated, because there will be a fair bit of math in today's conversation, because I want you all to understand how the dynamics of fundraising works. Here is the deal breaker or the heartbreak. I am not going to talk about how to raise money. That's an entirely different thing, which is what should the pitch deck be like, who to approach, what do investors like, what is it that you should be saying to which all investor, what are the contacts of them, none of that. That's the legwork that you have to do. That's the hard work as an entrepreneur you sign up for. My job here is to explain the basics of fundraising. What is it that you need to know going into the process? Which is, should you even raise funds or not? Should you raise funds and then know how is it that it works for you? How does dilution work? What is pre-money valuation? How do shares get allotted? What happens if one of your founders is also an investor? What happens to the ESOP pool? How does the voting rights change? What kind of rights do investors typically have? All of these things are things that are not known, not honestly discussed, and is just swept under the carpet. And my intention is to bring it to the surface, explain it to all of you in a manner that's simplistic, so that when you start the process for yourself, right from the question, should I raise money at all, it has some framework attached to it. You have some logic of how to go about it or not. All right, let's get started. There'll be 3 things that I'll cover essentially today. Number 1 is the first and most important question: should you raise money at all? It's a personally important question to me, because I feel that a lot of the media, the hype, the excitement, the sexiness of building startups is attached to the fundraising process. And so much so that we have attached the success of startups to fundraising. We really don't ask the questions of how much revenue are you making? How much profits are you making? No, we're like, how much funds have you raised? Oh my God, you've raised from Sequoia, you've raised from Axel, you've raised from Lightspeed, you've raised this much money. This must be really good. And that just takes the conversation in a different trajectory altogether. My humble admission is that fundraising is not for everyone. In fact, most businesses should not raise institutional capital. Most businesses should not raise money at all. And we'll go about explaining why. The second thing is, if you do decide to raise money, when is the right time to raise money and for what reason? And then finally, we will cover how does it all work? What are the dynamics, the terms, the calculations, the math behind the fundraising? Because that is when most people are like, I don't know this, let's get a lawyer, let's get an accountant, and you will get them, but you need to know the basics so that no one takes you for a ride. Okay, so let's start with the monologue. And this will be me just ranting through, because it's very important to set that context. And you'll have to give me that patience, you'll have to give me that attention, because this is a very important conversation. Should you raise money at all or not? Now, here's what I want you to know. And this is something that people don't know, but when I say it, and the way that I say it, it just strikes them hard. Investors are not in the business of building businesses. Investors are not in the business of building businesses. Investors are in the business of entering and exiting businesses. Investors are only in the business of entering and exiting businesses, which means when they put money into a company, they want to exit that business at some point of time and make a return on the capital. That is their fiduciary responsibility to all those they've raised money from. So when you look at any investment firm, it's Sequoia, it's Axel, it's Lightspeed, or the large global one, whether it's Tiger or it's any one of those large China funds or whatnot, All of them have raised money from someone called LPs or limited partners. And depending on the size of the fund, these LPs could be high net worth individuals, just rich people in general, or it could be really large institutions, pension funds, university endowment funds, sovereign funds like government surplus or something like that. So the bigger the fund gets, the bigger is the institutional LP that they are raising from. And the ones who manage the fund, the ones that you would speak to, the partners, the analysts, the associates, and so on, they're called the GPs or the general partners. Now, it's very important for you to recognize this. The role of the investment fund is to take someone's money, deploy it to get a return back. And they do recognize it's risky because they could have very well just taken a fixed deposit and gotten whatever, 5-6% that you get in India, or less than 1% that you get in the US. Or they could have put it in the public markets, which in the stock market would give about 10 to 12% maybe in India, and maybe around about the same thing in the US. But they're like, if you need a higher return, say in the ballpark of 18 to 20%, then you have to invest in something risky, and that's startups. These are private companies. They are leveraging technology. Most of them are leveraging technology to build something that could be massive, and you go early in so that you get multiples. But not all businesses succeed. Not all businesses succeed, right? So what happens? When you raise money, it doesn't look like debt, it doesn't look like a loan, so it feels like you don't have to give it back, but there is an implicit understanding that you don't have to return the money, but you do have to make a return on the money. There has to be something that makes the money grow. And in the event that the business does not work, the founders have a fight, the market does not turn out to be good, the business turns out to be not so big as was imagined it to be, some other technology flaw happens, some other regulatory thing happens, maybe an intense competitive war happens, whatever the reasons are for the business to not work out and for the capital to not see visibility of a return, the investor in their right will do everything that they need to save that amount. They will put in the checks and balances right when they're investing the money to ensure that whatever money is coming through, they get first access to it because they have raised it from someone who they have to give a return to. They really couldn't care less about the founders, about the business, or anything else. So it's very, very, very important that you ask yourself this question: why am I raising money at all? What is the reason to? And it's ridiculous, man, how many people tell me, I want to raise money because I've just started up and that's the only way I know. It's like people now think because you start a business, you ought to raise money because that's the way it works. That's not the way it works. That's not the way businesses are built. Businesses are built by creating a great product, solving a great problem, and making money through customers, running a profitable business. And that is the reason why people would want to give you money, because you are a healthy business to run. But if you're raising money because you're loss making, you're raising money because you don't have a way of generating profits ever, you're raising money because it's fashionable to raise, you're raising money because someone is giving you money, those are all the wrong reasons. And you are signing up to give a return to that money somewhere down the line. Here's what happens. You are a privately listed company, which means you don't trade in the market. Your stocks are not liquid. It's not like I can go and buy a stock whenever I want, right? So let's say an investor invests in you at a value of 100. Yeah, and forget the dynamics, we'll get to that. But let's say an investor invests in you at the value of 100. And they put in 10. So now they own 10% of the company because they put in 10 in a total value of 100. At some point of time, they want this 10 to grow, right? That's the return on their money. But if it's a illiquid asset, which means there is no direct way of knowing what the value of the company is today. Is it 100? Is it 120? Is it 90? Is it 200? Is it 50? What's the best way to know then? To raise another round. If you raise another round, some other investor will come in and say, I value the company at 150. and I'm going to put 15 in that. So now I own 10%, but the guy who put in 10 at 100 is like, great. The 10 shares that I had is now on a base of 150. And that's the way I know I am generating a return on my capital. So when you raise money institutionally, you raise money, seed fund, angel, pre-series, all those which we will talk about, all the terms, you're essentially signing up to raise money forever and ever. Because that's the only way you can show that the money of the investors is growing. That's the only way. So it's not a surprise that when investors put money in your business, they want you to keep raising. They want you to keep raising money because that is what tells them that the value of what they have invested in, the asset, which is your business, is growing in its value, and thus the money that they have put in is also growing in its value. And that's the unfortunate thing. You may not want to raise money, and for you to get an exit, which is either an IPO or a sale or an M&A, is just so far out. It's like 7-10 years at the least. No one's going to wait that long to see if the asset is truly that good or not. So what do they want? Raise every 12 to 18 months. When you have to raise every 12 to 18 months, and implicitly, no one forces you to do that, huh? But the implicit understanding is you will keep raising. Every raise will be at a higher valuation, and that means that the asset price is growing, and that means the value of the money the investor has put in is also growing. But when you implicitly commit to raising every 12 to 18 months, what does it mean? It means that the amount you raised previously has to be spent in those 12 to 18 months, because that is how the value of the asset will grow. You will deploy that capital, and that is what will make the business work. That is what will get you the best talent. It is what will get you the marketing eyeballs. It is what will get you the sales. It is what will get you all the PR, the branding, anything whatsoever. So you are essentially, when you raise money, saying, whatever money I raise, I have to spend that money as fast as I can so that I am ready for a new fundraise. And I hope by the money that I spend that rapidly, I'm able to grow the business and thus grow the value of the asset. That's a lot to sign up for. That's essentially saying, I will have to spend that money, even if I don't know how to. I will have to continue growing, even if there is no right way to grow. I will have to keep hiring or deploying money into marketing or wherever else, even though I may not have the right way to do that. I will have to keep fundraising, even if I don't want to, because the investor wants a return on their capital. So whenever you're thinking of fundraising and you read all those press articles, someone's raised this million, that million, yay, whoa, step back and ask yourself this question. Do I want to be part of this rat race, or do I want to do it for the right reasons? I stand here as someone who raised a fair bit of capital, and I can tell you it works wonderfully well if you raise it for the right reasons. But it's a disaster if you didn't know why you're raising and yet you raised. And that is where most people unfortunately are. They don't know why they're raising it. They don't really have a plan. They're just raising it because someone's willing to give them that money. They're riding a wave, whatever it is. Like right now, it's EdTech. Anyone who's building anything remotely to online education is raising money and is getting money. But the question is, what are you raising for? What is it that you're raising for? And do you recognize what is it that you're signing up for when you raise that money? And then there is this big consideration of liquidation, which I'll come right at the end of, which most people don't even recognize, comes back to bite them in such a big way. But hold on to that term, liquidation preference, also shortened as LICPREF. And that is a big virus and a big animal to deal with. But it's a personal question for you to answer. It's a personal journey that you have to undertake. There are so many people that will give you the right or the wrong reasons to raise or not raise. I can tell you whatever I know, but at the end of it, it's your decision. And once you have done everything possible to know what does it mean to raise money, we go on to the next step, which is when could be a right time to raise money and why should you raise money? When we're thinking about that, here's an important consideration that you should know. And this is not any sort of differentiation, any sort of discrimination, nothing like that. It's just the reality of how the business is wired up. Most of funding when it comes to startups is called venture capital. And what is the meaning of venture capital? Venture capital essentially means you're going to come really early in a company, and the core skill of the company, more often than not, is technology. More often than not is technology. That doesn't mean that they will not invest in non-tech companies, but more often than not, technology is a very important determinant of the company's existence. It's the core skill that the business needs to even exist. And why is that? The reason is because technology gives leverage. Technology allows people to do a lot more with lesser. I remember this one incident where I was having a conversation with a really big Russian investor. He's one of the richest people on earth. And he asked me this question: do you know how many coal mines are there, Ankur, that make more than $1 billion in revenue? How many coal mines are there in the world that make more than $1 billion in revenue? And I'm like, that's an odd question. I don't know. 200? I really don't know. And he's like, there are more than 2,000 of coal mines that make more than $1 billion in revenue. So if I had to invest money in billion-dollar businesses, I have enough options. I don't really have to have any conversation with anyone. I am having conversations with entrepreneurs such as yourself because I want to invest in technology. Because I know that the coal businesses are not going to become $10 billion overnight. They're not going to become $10 million perhaps ever. They are a declining business. They have peaked. They are slow. They use a lot of manual labor. There is technology, yeah, a fair bit here and there, but not like it drives it. But if I invest in an Uber, if I invest in an Airbnb, if I invest in an Amazon, if I invest in a Google, in a Facebook, then I am essentially investing in a vehicle that can become anything possible just driven by technology. And that is the power of technology. So, a very important consideration of when you should raise money and why should you raise money is dependent on whether you are a tech company or not. And that is just the way it is. But keeping that in mind, let's go to the framework. And that's my favorite point. 2 parameters that determine when you should raise money. And the first one, as I said, is are you a tech company or not? And let's say you are or you're not. And the second one is, are you generating revenue or not? Is there any revenue that is being made in the company as yet? And that is a no and a yes. Right? And this is a very simple tech revenue framework that I have constantly used to determine what could be a good time for you to raise money. And if you do raise money, what should be the reasons for you to raise money? If you are a tech company but do not yet have revenue, so let's say you've just launched, you're building the product, you're getting the first reactions and so on and so forth. So what should you do before you start thinking of raising funds? What point should you get to? And in my admission, you should in this quadrant is get to a MVP. Get to a minimal viable plan or a minimal viable product for you to even have a shot at raising any capital, which means you will have to walk in with a product and not just a prototype, not just an idea, not just something on paper, but something that you've built, something that you've experimented with, something that is showing early signs of what it could possibly be. It's a minimal viable product. And why are you raising the funds? for launching the product. So you've built an MVP and you've done it with your own money, with your own time, getting access to resources who've perhaps worked for free or worked for peanuts, whatever the case is, and you've got that early traction. And a large part of the MVP focus will be from tomorrow onwards on what to build, how to price, how to market, so on in the modules going on. But this is the bare minimum the bare minimum stage, in my opinion, that you should get to if you're a tech company and you want to raise money, which is get to an MVP. And why do you use that money? Why do you need that money? Is for launching the product. So basically giving the MVP wings so that it can become a lot bigger. If you are a tech company and you're already generating revenue, then the right time for you to raise money, or the right point to get to raise money, is for you to get to unit economics positive, which means for every transaction that you do, whether you're a B2C company or a B2B company. If you're a B2C company, the transaction is very clear. You make a transaction, there's a payment, and that tells you whether the transaction is over or not. If it's a B2B company, the acquisition of a customer or a client is a transaction. And unit economics positive tells you that whenever such transaction happens in your business, you make a net positive amount. Let me give you an example of e-commerce. When you ship a product through e-commerce, here's all the costs attached to it. It's the cost of the product that you're shipping, because you have to pay the merchant that you bought the product from, the cost of packaging, the cost of storing the product in your warehouse, the cost of shipping the product, the cost of any damage that may happen during the shipment, the cost of any refunds that may happen or any cancellations that may happen. And when you add all of this up, do you still make money? Is unit economics positive? And why do you raise money? For growth. So you're unit economics positive, which means every transaction, every client that you're getting is converting into positive dollars. Now, if you were to raise money, you'll essentially be able to expedite the entire experience. If you're selling 100 right now, you'll be able to sell 10,000. If you're getting 20 clients every month right now, you could perhaps be getting 200. If you're a non-tech company and you're not making any revenue, you have to get to revenue. And that's just the nature of the game. It's just that. You have to get to revenue, because if you're not a tech company, most institutional capital will not look at you if you're not looking at revenue. If you're not raising money, if you're not selling anything, if you don't have a business already. And why are you raising money here? Like what's the core reason for you to do that? It's for growth. You're making revenue, but now you want to grow. And if you're a tech company that already is making revenue, then people will not be like, hey, take my money. More often than not, they'll be like, get to profits. Which is somewhat unfair, but is the reality. If you're a tech company, then most people don't talk about profits. But if you're a non-tech company, people are like, make me the profit. Show me the profit, because I see that you don't have tech as a core leverage. So that's why I need to see profit. And if you're raising money at that point of time, why are you raising it? For scale. You're making a little bit of profit, but it's not like you're making humongous profits. So you would raise money to scale. And that is the right deployment. When you look at this very simple framework, very simple framework, it gives you a very quick guide of how you have to proceed, whether you're a tech company or not, whether you're making revenue or not. And this is just a ballpark. There is no right or wrong. You'll see enough examples not catering to this model. You'll see enough people who are raising money just on an idea. You see enough people who are raising money even if they're not profitable. You see enough people raising money even if they're not unit economics positive. All of those, trust me, are exceptions. They're not the rule. They are only discussed in the media. If you were to just go about and search and scan the entire universe, you'll be shocked at how few of those exist and how many of them are falling into this matrix of revenue and tech or not. And that will be my first guidance to you. Once you've answered this question, which is, should I raise money? And let's say you decided yes. At what point should I raise money? And depending on whether you're a tech company or you're generating revenue, you decide on that. Why should I raise that money? And you've got that answer as well as a guidance. The next step is, how does this really work? And that's where I want to spend bulk of our time today, because while it seems like that's something you don't have to worry about, I want you to be aware of everything that goes behind the scenes for you to be informed as an entrepreneur, as a founder, of what it takes to be participating in the fundraising process. What does it mean for you? What does it mean for your company? What does it mean for your value creation personally? What does it mean for the organizational existence in the future? For that, let's scan the entire universe and see how that works. Here are the typical steps that one takes when they go through the fundraising process. First, let's start with the terms, because these terms are thrown here and there, and I just want to make sure everyone's on the same page. First is, typically when you raise the first amount, it's done by someone called angels. And why are they called angels? Because they're like angels. They've come in from the sky and they're really helping you. They're God's messengers in some way, so they're out there to save you from whatever it is going through. Who are typically angels? Your friends, your family, your ex-bosses, people who have known you for a while, and some quote-unquote formal angels. Angels that exist in the ecosystem, most of them ex-entrepreneurs or current entrepreneurs, and theirs is giving back. It's their way of helping entrepreneurs get back, or at least start on their own, supporting them in whatever way. And that's where the first typical check comes from. After that is something called a seed round. And a seed round, as it's explained, is a seed round. Like, this is where you bow the seeds and you just wait for the first seedlings to appear, the first plants and the first fruits to emerge. And after that is something called a pre-series A. And then are the series. And series are, for some weird reason, alphabetically ordered, which then finally takes you to a exit. This is the normal course of how money is raised. Angels take the maximum amount of risk. They typically have no idea how this is going to pan out. Most of them end up losing their money. Very few of their bets make a lot of money. So there is a massive power law, which is the biggest thing that drives most of investing. And the power law essentially says is that no more than 1 to 2% of your investments will become really big. But if they become really big, they will just return your entire fund size and even more. So all that you need is to invest in as many businesses as you can with the right qualification, and then hope that 1 or 2 of them become so big that they just return your fund size. The rest may not even return their money that you put in. And most of them will die. And that's just the nature of the beast. It's just the reality of it. But unfortunately, we hear about the 1 to 2% and we feel, oh my God, this is so cool. We never hear about the 99% that died. And that's just classic survivor bias. So the angels take the maximum risk. And this is mostly unorganized. They're not like, oh, term sheet, hey, and these are the terms, these are the rights, and so on. They're basically just giving you the money because they believe in you. And then when you come to the seed, that's where the first flavor of formality or institutional capital keeps coming in. This is where documents will be shared seriously. This is when an evaluation will take place. This is the point that I was referring to for the 2x2 matrix of revenue and tech, because this is where you will have to be very sure of whether you want to raise money or not. Almost every business will need money from day one. But that doesn't mean that that's fundraising. That's just capital that you start with. It could be your own capital, your own savings, could be friends and family, could be your parents, could be anyone. And you just put in the money, hope that this will work. But most businesses just start with that money and never need any other money. But given the nature of the beast that we are in and the all cool and sexiness that we want to do around our startups, we were like, no, fundraising is the shit. And I want to go through that. And that's why people then commit themselves to, let's go for a seed, let's go for a pre-series A, blah, 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 blah. So a lot of the programs, like Sequoia runs something called Surge. You may have heard of it. That's a seed program. And there are a lot of seed capital firms that exist out there. Bloom Ventures is one of the best ones. K Capital is one of the best ones. So there are a lot of people that sign very, very early checks after the angel rounds, and they will essentially be taking just as much risk, but there is something that they see, whether it's a product, whether it's early traction, and so on. And then once you come to the pre-series and so on, this is like proper formal. This is you going through an investment committee, you pitching your idea, you making sure that all your numbers are intact, you're giving out projections, you're creating a business plan, the works. That's how it works. Now, when you go through this process, a very important thing, which all of you may have heard of, is something called the valuation of the company. And that's the cornerstone, or perhaps the most important metric that drives the conversation in any fundraising. Why? Because the valuation determines what percentage of the company will the investor get for the amount that they're investing. So what is it that they will own as shares in the company basis the amount that they're putting in? And this is the most understood or most misunderstood or the most complex behind the scenes kind of a mechanism, because no one really knows what the mechanism to get to a valuation is. Like, how does it even work? What's the basis? How do investors say, here's the money, but I need this much percentage, blah, 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 blah. And to be fair, most of it is honestly just gut. Most of it is just plain simple gut, rationalized by a lot of Excel sheets. But you know what? At the end of it, it is just someone trying to explain what they think is the right one. But over the course of my 10 years and a lot of fundraising, I've come up with some ballparks that I think are very effective and good guidances on how you should be thinking about your valuation. But here is the simple formula first to begin with, which is whenever a company is ready for investment, there is something called a pre-money valuation, which is the value of the company before this investment has happened. And this value is determined by the revenue that you have, the growth that you're experiencing, the industry that you are in, the team that you have, the kind of traction that you've shown so far. It's a lot of moving parts put in. And that's why it's very hard to determine what is a formula for this pre-money valuation. You can only have a guidance around it, which I will share with you. But this pre-money valuation plus the investment that is made in the company gives you something called the post-money valuation. And this is the simple formula of fundraising. That the pre-money valuation, which is the value of the company before the investment happened, plus the investment that happens, gives you the post-money. And the post-money valuation determines what is the ownership that every individual in that company now will have. And I'll walk you through the math because there is a fair bit of math behind it, but keep this formula in your head as the simplistic view of how fundraising works. Now let's try and answer the question, how do you determine or get to a pre-money valuation? If you have a company, you've been doing whatever it is that you're doing, what are the components through which you determine this could be or is likely to be the pre-money valuation for my company? And there I use a matrix that I call the tech revenue growth matrix. I have observed that at the end of it, the right team will almost always be able to raise funds. So if you are unable to raise funds, it could be because the investors don't believe in the team itself. So that becomes more of a qualifier. Like if you want to raise funds, you need to have a good team. There's no doubt about that. But beyond that, there are a lot of other things that play into part. And in my opinion, these three, which is the revenue, whether you're a tech company or not, and what's the kind of growth that you're experiencing, are the three biggest determinants of what could be the pre-money valuation for your business. And let's go through that. So the first thing that you ask is, are you a tech company or not? Are you making revenue or not? And are you growing or not? And while it could be somewhat easy to answer, well, it's really easy to answer revenue. You're either making it or not making it. Tech becomes slightly hard. Are you a tech company? Are you like an offline company disguised as a tech company and so on? And then growth becomes slightly harder because you may be growing, but is that good enough? Is that something which is a yes or a no? And I'll encourage you to not be boxed by this, but think of this framework as a guidance, which is what we've always done. And the simple way is no and yes, no and yes. So let's start with my happy rhyme, which is no, 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 yes, no, yes, no, no, yes, 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 no, no, yes, no, yes, 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 no, and yes, yes, yes. These 8 segments will tell you in a good manner what should be your ballpark pre-money valuation. Again, this is a guidance, but in my experience, this works really well. Most, if not all, fit into this 8 conditions, and every company, irrespective of where they are lying in one of these 8 cohorts that then determines what could be the pre-money valuation. So what's the guidance? So if you are not a tech company, not generating revenue, don't have any growth, and let's say it's an offline company that you're just starting, right? You want to start a shop and you're not a tech company, there is no revenue because you want to start a shop, there is no growth because of course you haven't started the business. So you essentially, my guidance is you shouldn't raise. And when I say raise, I don't mean angel and all. I mean don't raise institutional capital. Of course you will need money to start. Of course every business needs money to start. But the question is whether you will get it, and the question is should you raise it as well. So in this way, if you are not a tech company, if you're not generating revenue and you're not growing as yet because you haven't started or because it's not growing or whatever, you will not be able to raise money, and you should not be raising money as well. You should just simply be relying on friends and family, your own savings, and get to a point which then works for you later on. If you are not a tech company, you're not generating revenue, but you're growing. And a good example could be, I could think of one, which is, let's say you run an art gallery. You run an art gallery where a lot of people come and see the art. You're not really making any revenue because it's not like you're charging anything for someone to sell or someone to walk in. It's not a tech business, it's a completely offline business, but it's growing. Like people are coming in and they're coming in hordes and so on and so forth. You still will not be able to raise money. You still won't be able to raise money because it is just way too early for a non-tech company to come in. But what you should do is, of course, don't raise, but get to revenue as fast as you can. Just get to revenue as fast as you can. Go back to the matrix, the revenue tech matrix. That's the guidance there. So there is no pre-money guidance. There's nothing that you can really get out of here. The simplest and the best thing for you is raise the revenue, make the revenue, because you won't be able to raise it. If you are a non-tech company, you're generating revenue, but it's not growing. And a good example is, let's say, an offline store. You just started a store and it's like a neighborhood store. It's just one, you're there. So you're raising some bit of revenue and so on. There, mostly, if you were to look at how funding has happened, and it's very rare to raise in this cohort, but if at all funding has happened, it typically is 1x of revenue, which means if you're making 10 lakhs a year as revenue, the valuation of the company pre-money will be 1 times that, which is 10 lakhs. If you're making whatever is it that you're making on an annual basis as revenue, the valuation of the company will be round about the same number, just 1x revenue. That's where most, if not all, of the transactions in this cohort have happened. Again, with the admission that this is a very hard cohort to raise money from. If you are not a tech company, you are generating revenue and you're growing. So let's say you've started a retail chain and you're opening up multiple retail chains. And that's a good sign. So it's like you're growing, your revenue is growing. It's not just one store, but it's a chain and so on. There, the guidance is 3 to 5x revenue. Which means that if you make, say, 10 lakhs a year total as a business, the valuation of the company pre-money will be between 30 to 50 lakhs. If you are a tech company, not making any revenue, not growing, so let's say you're just starting up. You have an idea, you've got to an MVP, you've shown some early signs, you're not making revenue, you're growing, but it's at an MVP state, so it's like zero growth technically. There, the ballpark, and this is India, this is not outside, you will be valued at less than $1 million pre-money. So because there is no revenue, there is no multiplier of that revenue, and it mostly is a number guidance, which is around $1 million. Note the difference between offline and online, or tech and non-tech. If you were exactly in the same cohort, but a non-tech business, you will not be able to raise money. Because you're tech, you can perhaps get to a point where you can be valued at about $1 million or so. If you are a tech company, you're not making revenue as yet, but you're somewhat growing, there again, it's between $1 to $2 million. If you are a tech company, you have revenue coming in, but you're not growing as yet. So it could be because it's early signs, it could be because you've run into rough weather, it could be because of the industry which is not growing so fast, it could be something else. There typically, this is 5 to 8x revenue. And if you are a tech company, you have revenue and you're growing, then that is the best segment to be in, and that's where you also get the best multiples of 8 to 12 times your revenue. Which means if you're a tech company and you're making 10 lakhs every year, but it's like growing. It was 5 lakhs last year, it's 10 lakhs now, it's perhaps going to be on a trajectory of 25 lakhs the next year and so on, you would be valued at between 80 to 1.2 crores, 80 lakhs to 1.2 crores, because you're in the last quadrant of tech company with revenue and growing fast. This is the broad guidance framework of how to determine pre-money valuation. This is what is used by most founders and entrepreneurs to have a ballpark sense of what could be raised and how. Now, why is this important? It's very important because most people think that the amount they will raise is abstracted from how big the business is. I'll give you an example. I was speaking to someone last month. It's an individual that runs organic farms. He has 15 years of experience, very smart, very capable individual. And he runs organic farms that makes spinach. And it's fully organic, it's beautifully packaged, and so on and so forth. He does revenue of about 30 lakhs a year, about 2.5 lakhs a month. And when I asked him, how much money do you want to raise? He said, I want to raise 10 crores. I said, okay, why do you want to raise 10 crores? I said, because it takes me almost 60 lakhs to set up a farm. And I want to set up around 10 to 15 farms. So I want to raise about 10 crores. I was like, do you even understand that if you are 30 lakhs as a non-tech company, and it's not that they were growing rapidly, it was like 20 lakhs the year before, 30 lakhs now, and so on, you're not going to raise 10 crores. Because the valuation of your company itself is so low that if you were to give 10 crores to someone else, let's say by a magic wand you're able to raise 10 crores, that person will own 100% of the company. Did you think through that math? And clearly they hadn't. And this was a very smart individual. And I was shocked at how much there is asymmetrical information that flows around of people saying, the money that I need is the amount that I should be raising. No, the amount that should be raising is contingent on what's the value of the company right now. How much do you afford, or can you afford, or do you want to dilute or give away? And thus is a derivation, not a desire. The amount that you need or will be able to raise is a derivation, not a desire. You can't say, I want to raise 5 crores. Let's make it happen. You have to start with what's the pre-money valuation of your company, What's the likely percentage you want to give away, and thus determine what is the amount that you can raise right now. And that is just missing from so many people and their understanding. So let's go through the math. And this is where the math begins. So for those who are kind of scared, brace yourself. This is going to be a nice, happy introduction to 9th, 10th maths. And don't feel intimidated. It's very simple. It's not complicated at all. Don't tell yourself the story that you don't understand this. It's everyone's job and everyone can do it. So here's how it works. Let's say you are someone who makes 1 crores in revenue a year. You're someone that makes 1 crore revenue a year. And what you want to do is you have 2 founders, and let's make it simple. The 2 founders are 50-50, and they have 100 shares in the company. So the structure of the company is right now, founder 1 has 50 shares, founder 2 has 50 shares. So total shares in the company are 100. And thus, as a ownership, founder 1 has 50%, founder 2 has 50%. Simple? Yeah? No rocket science. It's very simple. Now let's say there's an investor that comes in and says, I want to invest 25 lakhs in the company. And the question now you have to answer is, how much will the investor get? And how much will founder 1 and founder 2 now own after this investment? And how does that work? So first, if there are, and let's say this guy, he comes in at the same 1 crore pre-money. So this guy is like, okay, you know what, you're an offline business and I'm going to value you at 1x revenue, so you come at 1 crore pre-money. Now, if the value of the company is 1 crore, before the investment, what's the value per share? So the share price is 1 crore, which is the value of the company, divided by 100 shares. And that is then 1 lakh rupees. The share price of every share is 1 lakh rupees, and there are only 100 shares. Okay? So now, if every share is valued at 1 lakh, for 25 lakhs, how many shares will the investor get? The investor will now get 25 shares. How? It's 25 lakhs that the investor has put in upon the share price, which is 25. Let's go through this again. The investor says, I'm going to put in 25 lakhs at a pre-money of 1 crore. So thus, what is the share price? The share price is 1 crore, which is the value of the company, divided by 100 shares, which are the total shares in the company that the company has right now. So thus, the value of every share is 1 lakh rupees. So for 25 lakhs, how many shares is the investor going to get? 25 lakhs divided by 1 lakh, which is the share price, that equals 25 shares. So now, what's the new composition of the company? The new composition of the company is pre-investment. This was 50, 50, and 0. So there were 100 shares in the company. And post-investment, it is now 50, 50, and 25. So there are 125 shares in the company. And because of that, the percentage now is what? It's 50 upon 125, which makes it 40%, 50 upon 125, which makes it 40%, and 25 upon 125, which makes it 20%. And that's how it works, which means if someone came in at a 1 crore pre-money and put in 25 lakhs into the company, everyone will get diluted by 20%, which is what the investor gets. So there are new shares that are formed into the company, and because of those new shares, everyone's valuation remains the same, but ownership percentage goes down by the 20% that the investor has got. And that's how it works. By how much can one increase the number of shares? You can increase the number of shares as much as you want, Apurva. It doesn't matter. You can always increase the number of shares. This is exactly what happens when any investor comes in. When any investor comes in, they just increase the number of shares. So this 100 going to 125, 125 going to whatever, that is a completely unlimited process. There is no regulation around that. Shouldn't the number of shares be the same? No, the number of shares are the same only if the shares are being transferred and transacted, which is what happens on the stock market. In the stock market, when you buy a Reliance share, you're buying it from someone else who already owns it. But if there is new investment that comes in, let's say Facebook today is buying shares in Reliance or Jio, they're buying new shares in the business. They're not buying it from the Ambani family or anyone like that. It's a new investment that generates new shares in the business. We'll take one more example because then that will make it very clear. Okay? There are 10,000 shares in the company. There is founder 1 who has, say, 60% of the company. So they have 6,000 shares. There's founder 2 who has 30% of the company. So they have 3,000 shares. And there is ESOP because someone asked that as well. 10,000. And what's the ownership? 60%, 30%, 10%, which equals 100%. Okay, all set? So this is what the company is right now. Who determines the number of shares? You determine the number of shares when you start. Most shares in India, they start with a price of 10 rupees. And the minimum amount that is needed in India to start a private limited company is 1 lakh, which means that most companies, when they get started, they start with 10,000 shares at 10 rupees, which equals 1 lakh rupees. Yeah, that's the standard thing, and which is why most examples, if you see online or anywhere else, will have 10,000 shares. Okay, so now an investor comes in and says, I want to invest 25 lakhs at 1 CR pre-money. Now, if they're investing 25 lakhs at 1 CR pre-money, what's the share price? The value of the company is 1 crore, which is this, divided by the number of shares. So that makes it rupees 1,000. So every share is worth 1,000 rupees in the company right now because the value of the company has been determined as 1 CR. So for 25 lakhs, how much does the investor get? They get the 25 lakhs divided by 1,000, which is 2,500 shares. Yeah, so that's the shares that are issued to the investor for bringing in this capital into the company. So now, what's the new ownership of the company? And let's say we bring investor here. The investor has 0 at this point of time, but now there is 6,000, 3,000, 1,000, and 2,500. Yeah, so that's the new, it's called the cap table. That's the new cap table of the company, or the capitalization table of the company. And what does that translate into from an ownership perspective? So now the total shares in the company are 12,500, which have increased from the 10,000. And if you were to do 6,000 upon 12,500, you will get 48%. This guy will become 24%, this will become 8%, and this will become 20%. And that will be the new ownership of the company, which means founder 1 would have moved from 60 to 48, founder 2 would have moved from 30 to 24, and the ESOPs would have decreased from 10 to 8%, while the investor will have 20% for the 25 lakhs that they invested at 1 crore pre-money. So that is the pure math of how fundraising works. This is the very simplistic view of how dilution works. Now you'll see it's pretty drastic and dramatic because founder 1 moved from 60% to 48%, which means he moved from majority to less than majority with just simply one fundraise. And that just at 20%. Like someone said, I want to put in 25 lakhs and 1 CR, and that's it. The money moved completely, and thus the dilution as well. But here's the real thing. Dilution is a reality. It's a pretty stark reality. And this is how it works. If you were, and I'm just saying that this is the way it is, if you had two founders, both of them at 50-50 to start with, and they go to 5 rounds of fundraising. If they go to 5 rounds of fundraising, and let's assume an average dilution per round. If the average dilution is 20%, 25%, and 30%, here at the end of the 5 rounds will be the resultant ownership of these founders. At 20%, the founders will have 16.38% each. At 25%, they will have 12.66% each. And at 30%, they will have 9.6% each. This is how crazy it is. Let me explain this once more, because this is very important for you to recognize as a founder. With every fundraise, you dilute yourself. You dilute it to the extent that you're giving the investor an ownership of that company. If after 5 rounds you had on an average diluted 20% in every round, you will drop from 50% to 16.38% at the end of the 5th round. If you would have diluted 25% on an average, you would have diluted from 50% to 12.66%. And if you were to dilute 30%, you would have diluted to 9.6% or less than 10%. This is why when you actually read the cap table of really large companies, you will see that their founders do not own more than 10% usually. And pick any company. Pick any company and most of their founders do not own more than 10% of the company, which means technically they have become an employee of their investors. 90% of the company is owned by someone else. Jeff Bezos owns 14% of Amazon. Mark Zuckerberg owns about 27% of Facebook. That's just the reality. And these are the best examples. These are people who raised on their terms. When you see people who didn't raise on their terms, let's say all those people who may be raising right now during COVID times because the business is not doing well and they need the capital, will be raising at really poor valuations, will need a lot of money, so their dilution is going to be in excess of 25-30%, and they're giving a large share of that company literally every round. And that is something that just eats the company up very rapidly. So the next thing you know, it's like parents with kids. They're like, oh shit, how did they grow so fast? I lost so much time. And the founder is like, oh my God, how did I dilute so much of my equity? I own nothing in the company anymore. And that's because you signed up for raising money every round. But every round comes with a dilution. And that's why you end up where you end up. So it's very important for you to recognize that while a lot of people will say, oh, you know what? 100% of zero is zero, but 10% of $1 billion is a lot of money. That is true. But what if you don't become $1 billion and you still own only 10% of a company? And I'm a living example of that. Nearby is a $100 million company. I own 10% of Nearby, but that is not commensurate with what I thought it would be. Because even my investors and me, we all believed that we're going to become $1 billion company, but we didn't. We didn't become $1 billion company. But to become $1 billion company, we kept raising money because we thought that we will. I didn't make very wise decisions around that. And now we're at the spot where we're growing, but we're still a $100 million company with a lot of capital raised, and I have diluted myself to less than 10%. And that means I own not a lot of sum as against what I thought I would or what my investors wanted me to. And that's just the reality. When you're raising money, and this is something that will be applicable to all of you right now, it's very hard as we figure to determine what the pre-money valuation of a company is, because every math just starts with that. So to circumvent that, a lot of investors, particularly early on, angel, maybe even seed, they said, you know what, why do we even want to get into that conversation? It's like a useless conversation. It's like a you versus me. No, this is the valuation, this is the valuation, this is the valuation. We don't know. Why don't we let the market decide what the valuation is at some future point of time? So here's what I'm going to do. I'm going to give you something called convertible debt. I'm going to give you debt. I'm going to give you a loan. But that loan has a very special thing. It will get converted into equity at some point of time in the future. And what will be that time in the future? When you actually go on to raise the next round. Because the hope is that by the next round, you will have revenue, you will have growth, you will have some metrics to help classify or quantify what the pre-money valuation is. Today, we don't have anything. I just love you as founders. I believe in you. I believe in the product. I believe in the market. But should it be $1 million? Should it be $1.5 million? Should it be $500,000? I don't know. So let's just avoid that conversation and do a debt or a loan instrument which converts into equity in the future. And if we do that, then the next round will determine at what price does this debt convert. I'm not going to go into the math of it because I'd say it's slightly more complicated than what we did. Not that what we did was complicated, but it's slightly more complicated and it's not important right now. But it's important for you to know that don't stress upon what the pre-money valuation is. If you are at a point where you are having a conversation with an investor and you're not able to decide or negotiate on what the pre-money valuation is and thus what will be the ownership of the investor, the best way to do that is to go for convertible debt. And in that mechanism, whatever money the investor puts in, it's assumed as a loan which gets converted into equity in the next round. The biggest thing you need to know though is that there needs to be a next round. Why? Because if there is no next round, this is legally looked at as loan, which needs to be paid back. So you are morally, financially, legally obliged to pay back that loan or convert it into equity. So if there is no follow-on round because the business is not doing well, you don't want to raise money or whatever the case may be, you will have to return the money back at a certain period of time. So it's even worse because it now mandates you to raise money. But in the event that you can't settle on a pre-money valuation and you don't want to spend time in just negotiating and going back and forth, you just do a simple convertible debt. And that's the way that it works. The last thing that I want to speak about is something called liquidation preference. When you get your money from an investor, recognize the investor is in the business of entering and exiting businesses, which means they want to get their money back with a return. So, in tomorrow's event, when there is an exit, let's say you have raised $1 million overall, ever, and there is an exit opportunity for you. And the investor owns 40% of the company, you own 60% of the company. Most people will think that if you sell the company for $2 million, the investor will get 2 million ka 40%, that is 800,000, and you will get 2 million into 60%, which is 1.2 million. But that's not how it works. The way that it works is that there is something called a liquidation preference or a liq pref. And a liq pref is that whenever there is an exit, the investor will first take out the amount that they invested and then it will be split amongst the investors and the other shareholders. Which means if you sell the company for $2 million, the investor will first take out their million and then the remaining 1 million will be split in the same ratio as the ownership. If that happens, it's called a participating liquidation preference, which means that the investor participates and takes the first amount, their principal amount, and then participates in the remaining amount with their ownership. So the investor in this case will not get 800,000, they will get $1.4 million. The 1 million that they already put in, and of the remaining 1 million, the 40% that they own. And you will, for 60%, only get $600,000. That is a big deal. Here is why. Because if you now, for whatever unfortunate reason, had to sell the business for $1 million or less than $1 million, you're not going to get any money. You're not going to make any money. I'm saying this again. If you were to ever raise whatever quantum you have and unfortunately have to sell your company for that amount or lesser, you're not going to make any money irrespective of the ownership you have, because there is a liquidation preference built into every investment. The investors have the first right of access to what they have put into the company, and it's after that that the proceeds are shared. Now, when you think of that, you suddenly now recognize how hard is it to make money through a fundraising process. Because it's not just about the dilution, which is going to make your ownership lesser and lesser and lesser. It's also about the liquidation pref, where all these massive amounts of money that are being raised, you need to sell your company at a higher amount than that to be able to make any money at all. Because if you were to sell even for that amount or lesser, you're not going to make any money. A passing thought. A few of you asked what's the difference between ownership and voting rights? Like, what's the nuance of why do investors ask for 26%, 30%, and so on and so forth? So here's how it works. First, typically every share that you have gives you a voting right. And what's a voting right? A voting right is the ability for you to vote on any important company matters. And typically a company operates by a board, which means if you have an investor come in, then they will form a board. The board will have the investor, will have you as founders, and that will comprise the board. So you as the CEO of the company will now report to the board. And the board will be responsible for making the most important company decisions. Not every decision, but it will be recognized in the fundraise itself what all decisions need to come to the board. Typically, it's about you raising another round of money that needs to come to the board. You're raising any loan that needs to come to the board. You're entering into any new business that needs to come to the board. You're exiting some new business that needs to come to the board. You're making a very senior hire, a very expensive one, or you're issuing a lot of ESOPs to that hire. It needs to come to the board. So material things, not like on a daily basis. It's not micromanagement. And the board then votes on that. So they vote on it, and typically a simple or an absolute majority works. What's a simple majority? Anything more than 51%. What's an absolute majority? Anything above 3/4 or 75%. So if you have your shares in the company equal to a voting or equal to a vote, then if you have 10% of the company, that means you have 10% voting rights. If you have 50% of the company, that means you have 50% voting rights. And that's why a lot of founders do care about not just the ownership they have in the company, but also the voting control they have over the board. Mark Zuckerberg is a great example. While he owns around less than 30% of Facebook, from a voting perspective, he has majority. So he designed his votes in such a way, one of his stock is equal to 2 votes. So he basically has a higher voting percentage than everyone else. And that's why he doesn't need to necessarily ask the board for permission to do whatever he wants to do in his company. How do you get to that point? Only if you've built a company that most people want to be a part of. It's so desirable that they will agree to any terms that you have laid out for them, as against you agreeing to every term that the investor has laid out for you. And that's, as expected, very rare. It only happens in very few cases where the company is such a fascinating company growing so rapidly that the founder will dictate the terms on which the fundraising happens. More often than not, fortunately or unfortunately, the fundraise happens on the terms of the investor. As we discussed in the last module around founder equity and ESOPs, the minute an investor comes in, all the ownerships, the ESOPs and the founder ownerships, go on a vesting schedule, because that is the investor's way of ensuring that the founder is in the business for at least some period of time and there is no execution risk to their money. Because if the founder has 50% and all of that comes to them on day one itself, then they can technically leave the company the next day and saying, great, I own 50% of the company, I raised this money, and now I'm going to get someone else to operate it. I don't have to do it. And that's not what the investor wants, because the investor invested the money to have the founders run the company, so they will create that lock-in. They will create a vesting schedule. They will have that vesting usual dynamics that we understood in the last module. I'm not going to repeat them, but essentially the founders will also be locked into the company along with the employees, and they will be expected to stay for a certain duration within the company. If any of the founder leaves, that is when you go out and whatever is unvested for that founder comes back to the pool and may get distributed everywhere else. Which brings me to one question I want to answer, and that was a very important question a lot of you had raised, and now it should be very clear on how it works, which is, what if one of my co-founders is also an investor? If your co-founder also happens to be an investor, you have to very clearly dissociate the co-founder equity and the investor equity. Don't mix the two. Don't mix the two. So there are two frameworks that you use. Framework one, go back to the last module where we decided and discussed what is the framework to decide co-founder equity. It was a combination of the core skills, whether they have it or not, whether they were there from the start or not, and whether they drew market salary or not, the triple S framework. Basis that, you know what should be the split between you and your co-founder. Let's say it's 70-30, 70% for you, 30% for your co-founder. But your co-founder says, I also want to put in money, 20 lakhs, and I will put it at a 80 lakh pre-money valuation. So if he puts 20 lakhs in a company that's 80 lakh pre-money, and how do you decide the 80 lakh? It's just a decision. There's no science behind it. It's just a conversation. It's just a negotiation. It could very well be a convertible debt, but let's assume that that is what happens. It's 80 lakh pre-money. So the total value of the company now is 1 CR, and his 20 lakhs is now going to give him a 20% in the company. So now everyone who was already in the company, which is just the two of you, 70% and 30%, gets diluted by 20%, and the new investor, who also happens to be your co-founder, gets 20%. So what will be the new ownership? You will get diluted by 20%, which means of the 70% that you have, 20% of it, which is 14%, will go away. So you will now be left with 56%. Your co-founder had 30%. He will get diluted to 20% as well and will be left with 24%, which is 30% minus 20% of 30%. Plus, he will get the 20% as an investor. So the new cap table of the company will be, you have 56% and your co-founder has 24% as a co-founder and 20% as an investor, which equals 44%, total 100%. Okay? Simple math. There's no complication around that. But the important thing is you dissociate the co-founder equity from the investor equity. The co-founder equity is a separate conversation. You have it on the basis of the triple S framework, and that's where it stays. And then you bring the investor conversation. It just happens to be the same person, but the two mechanisms should be treated differently, separately. Combined, it will be the same thing. And that is how a co-founder as an investor works as well. There are just so many nuances that are there in fundraising that it can become a module and a masterclass in itself for 16 hours. But I hope that this is just the start and the early surface introduction for you to understand what all do you need to know before you go into a fundraising process. We covered why should you raise money in the first place or not. We then went into when should you raise money and for what process. And then we covered how does it really work, pre-money, post-money, how do new shares get created, and thus how does the new ownership look like. The biggest thing there is dilution. It's a reality, and a big and a bad one at that. It just happens so rapidly, you don't even know that it hits you. And the next thing you know is you went from 100% ownership to like 10% ownership. And oh my God, what just happened? People told you that you'll own 10% of $1 billion, but you know what? It's still 10% of a company. And now you're technically an employee of your investors. Harish, Do operating losses in initial years hurt the chances of getting further funding? No, not really, Harish. Everyone expects every business to be making losses in the early years. That is not considered to be a detriment or anything negative. Of course, if the losses are not reducing as a percentage of revenue or they're not reducing at all, that is not looked at favorably. Faizan, what are the possible hurdles in raising subsequent rounds? The biggest hurdle, Faizan, of raising subsequent rounds is that the business is not growing the way that you expect it to, or is not growing with the economics that you were expecting it to with. And those are the biggest problems. So that means you are either just burning money, but it's not resulting in growth, or even if you're burning money, it is only making the losses go bigger and bigger. Both of these are not necessarily the best signs. And the only thing that unfortunately then takes care of it is just supernormal growth. And that explains to some extent why very big loss-making companies in India still continue to raise money. It's simply because they are still growing very, very rapidly. Bhavya, even if we raise money after 3 years of starting for the first time, will it still be seed? Yes. So the nomenclature, angel, seed, blah, 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 this is not specific to when the company started. It is specific to when you raised the money. So the first color of money is called angel, and then seed, and so on. If you've already been in business for 3 years, you directly go into seed because angel is being bypassed. Saurabh, what is the difference between scale and growth? Scale is when you are doing whatever is it that you're doing, but now you're doing it at a bigger scale. So a good example of that is nearby. We're there in one city. Now we want to be there in 20 cities. That's scale. What is growth? Growth is you're there in one city, but in that one city, you're growing very rapidly. That's the difference. So growth comes from two things. You're either growing in that one thing that you're doing, or you're growing by doing multiple things. And that's the difference between scale and growth. Yanish, should I not expect more from an investor apart from money? Absolutely, Yanish, absolutely. The investor is coming in with money, but there's always a color of the money. There's always a color of the money. You raise money from non-professional or informal investors, and you're not going to get a great experience. There are people who will be micromanaging you. There are people who will be checking on you. There are people who will be asking for what's happening to their money and so on. You raise money from institutional investors, Sequoia and the likes, you'll get a lot of guidance, you'll get a lot of exposure, you'll get a lot of know-how on how to run large companies, how to make them successful. So the color of the money is just as important as the money itself. And there, it's a good point that you raised. Do your due diligence and do it in such a manner that you have the ability and the option to say no to someone whose money you do not want. If you're unfortunately at a spot where you can't say no to anyone because that's the only money you're getting, you most likely will get the worst kind of money. And that's just the truth. So it's very important to set yourself up in the business in such a way that you're able to raise money in the manner where you also get a lot more than just money itself. Vivek, do the assets of the business or startup don't account for in the pre-money? No, Vivek. Most of the pre-money valuation is based on the revenue or the cash flows that the business makes. The assets are not a part of that pre-money valuation. The only asset that is counted is actual cash, not hardware and tools and stuff like that. Ashima, in liquidation preference, if a founder wants to sell off their part of shares, then how will it work? So here is, and liquidation preference has nothing to do with the founder trying to sell the shares off. Let me just tell you how it happens. So there are cases where you would have heard where the founder sells their shares to maybe the current investors or to new investors. And the example that Ashima quoted was Binny Bansal of Flipkart selling his shares back to Walmart. That is called a secondary transaction. What is a secondary transaction? It's almost like a stock market transaction where when you buy a stock, you buy it from someone else who already owns the stock. So no money goes into the company. All money goes into the pocket of the investor who owns the stock. And that is called a secondary transaction. When do secondary transactions happen? Secondary transactions don't just happen because founder wants money. Because here's a big term that the investor will always put to their investment. It's called the right of first refusal. What does it mean? It means whenever there is any situation, context where someone else is willing to buy shares of a current investor, then all the current investors have the first right to sell. And only if they refuse can the founders sell their shares. And why is that? Because investors like, hey, I've put in my money. So if there is any opportunity to sell, I should be the first one to sell, not you. If I think I don't want to sell, then I allow you to sell. In this case, it becomes complex because you can imagine there will be multiple people who will want to sell and how. So typically what happens is the following. Let's say there is an investor that says, I'm willing to do a secondary of 1 crore. And all the investors are like, you know what? It'll be stupid of us to just take all of that 1 crore. So why don't we split this 1 crore in some sort of a ratio so that some part of the 1 crore also goes to the founder to be able to sell their shares. So let's say the founder gets rights to sell their shares worth 10 lakhs, and that's what they can do. So to whatever extent the founder can, they can sell shares of 10 lakhs. The remaining investors will sell the shares of 90 lakhs, and those 1 crores will then get distributed amongst themselves. No money will go into the company. All of it will go into the pocket of the investors, and the investor who put in that 1 crore will now have shares worth 1 crore. Typically, when this transaction happens, it happens at a discount to the pre-money valuation because cash is considered to be more valuable, and that's why if you are getting hard cash, you have to give some sort of a discount to the investor who's willing to buy. So if the last round was, say, at $1 million, then typically people will say, hey, give me a 20% discount. So I will now buy the shares, assuming that the value of the company is $800,000. And that's how it works. Amit, please, can you talk about drag along and tag along rights of an investor? So Amit, very quickly, and this is for the benefit of everyone, I didn't want to necessarily complicate that because these are terms that come way, way, way in the end. But here's how it works. First, tag along. What is tag along? It's exactly what I described right now. An investor says, if there is any opportunity to sell, I have a right to tag along. So if there's anyone who's willing to buy shares, irrespective of who they're willing to buy it from, I have the right to tag along and sell my shares as well. What is drag along? Drag along is if I want to sell my shares, I have the right to drag the other investors to sell as well. That is how it works. So if the investor, let's say, and why do drag along rights exist? It exists because the investors raise money from their partners for a certain period of time. It usually is 7 to 10 years. At the end of that, they have to return the money back to their partners. At that point, they're just very quickly exiting. So what will they do? They'll say, it's the end of 7 years. Let's say that's the end of the fund. And they'll like, I found a buyer. It's not the best thing ever. It's like 2x of what I invested in, but I have to exit because I have to give the money back to my investors. So I'm agreeing to this 2x and I'm dragging you all along. So in that case, the founder cannot really say no to the deal because the investor has a right to drag along the founder and the other investors to agree to any deal at a certain point of time. That's the drag along right. Tanya, Netflix is a great example of the founder as an investor. Absolutely. Roshan, do investors invest in LLPs too? If yes, is it harder for an LLP to raise funds? Yes, Roshan, it is harder for LLPs to raise funds. Typically, investors like private limited companies. Should all shareholders dilute pro rata or can there be differences? No. All shareholders typically dilute pro rata. Only in exceptional cases, Roshan, do the shareholders decide that no, I'm going to give out a lot more than the others. And that's how. The one exception though is ESOPs. So here's what happens, and you can imagine this to happen. Let's say the desirable ESOP pool in the company is 10%. Now the investor will not want that they put the money, get the ownership, and then the ESOP pool is created. Why? Because then they will have to dilute to create that ESOP pool. So what they want the founders to do is create the ESOP pool and create the ESOP pool in such a way that even after my ownership, the ESOP pool is at 10%. So you will have to dilute for that. So that is a case where not all the parties dilute pro rata, but only the founders do to create the ESOP pool, and then the investor comes in. This is called a fully diluted basis. That is what the term is. That means the company is fully diluted, no one will be diluted any further, and after that, the ESOP pool is still at 10%, which means that the dilution has happened from the founders itself. If a founder eventually becomes an employee of an investor, what keeps them going on or motivates them realizing it's not their company anymore? And that's a very, very deep question to ask, a very personal question to ask as well. I really don't have an answer to that, because here's the truth. Most founders are not necessarily driven by the ownership of the company. They're driven by the joy of creating that business, the joy of making it run, the joy of making money through it, the joy of making that company become public or see a good exit, and so on and so forth. So at some point of time, they do rationalize that, and do rationalize it very well. But it's also true that there comes a time when the founder's like, you know what, it's not worth it anymore. And maybe it's right for me to just leave this, go on to do something else. I have my equity vested in, and perhaps it's the wiser thing for me to get someone else to run this and not be a part of this. And that also happens. Ronak, if there is a partial exit due to lesser inflow compared to valuation, who gets to exit first? Is it first in, first out, or last in, first out? It is last in, first out. The shares are always given a certain preference, and the last investor gets the highest preference, and the founders, of course, get the lowest preference. So if there's a partial exit, then the LICPREF offers or runs on a LIFO basis, and that's the way it works. Rahul, is there any legal action that will be taken against founders for not returning the amount as expected by investors? No, Rahul, nothing like that. This is an equity, which means if you don't return that amount, there is no legal action that happens, but there's an implicit understanding that you will be returning the capital. Veenam, how does solo founder impact fundraising? Here's the truth. Most institutional investors do not like solo founders. They do not think highly of it, for the simple reason that they believe, and it's true, they believe that starting up and running a business is very, very hard, and you need partners who come in with the right skills, with the right support, with the right balance, and that is what they look for. As you may have remembered in the session of getting a co-founder, that's not what the data suggests. Most businesses that have gone on to at least raise money, if that can be used as a proxy of success, 45% of them had solo founders, and very few had two or more than two founders. Anuj, there are times when companies have money lying in the bank. How are investors okay with this, knowing that they have technically raised more than required and not using it? So Anuj, the only reason why that would be still a likely scenario where funds are raised is because the company is doing exceptionally well and the investors want to be participating in the company. It's not that the company needs it. So what the company does is, all right, if selfishly I can give away only a small part of the company, still raise a really large amount, I will just get more and more cash ammunition to fight. A good example of that is Byju's. Byju's is growing like crazy. It's very profitable. It has enough cash in the bank, and yet it continues to raise money. Why? Because people are willing to give. And they're willing to give on great terms. Byju's like, why not? If I can have all the money in the world and give away only small percentages, then that's the smart thing to do. That's exactly what Jio also did. It got to a certain size where, of course, it has a lot of money off the balance sheet of Reliance, but it also has a lot of debt. And to clear that debt, it said, I'm going to make such an attractive proposition that the world will want to bite into it, and I'll give the small percentages away to the company. So technically, only 30% of the company has gone, and the entire debt of the company, which is about $20 billion, has been removed. And that's remarkable, but only a few instances and rare instances where that would happen. Abhi, what is sweat equity and why do mentors demand the same on day zero? So sweat equity, Abhi, is equity that you get for your sweat. That's just as simple as that. It's equity that you get for your hard work, and that's why most mentors ask for it. There's a complication though. In India, you cannot issue shares to anyone who's not an employee or has not bought those shares. You cannot issue shares in India to anyone who's not an employee or has not bought those shares. So anyone who asks for sweat equity and you give them, technically they don't have any equity, because on paper they're not even eligible legally to have any equity. My suggestion, and this is a role that I play sometimes as a coach, as a mentor to founders, is you essentially ask for a certain investment And basis of that investment, you issue equity, which could be a lot more than what that money would have bought. So let's say if you are a 1 crore company, pre-money, and advisor or the coach, they put in 1 lakh. Technically, they would have got about 1% of the company, but you could give them 2% because they are also an advisor or a coach. And that is how it mostly works. That will be the right way to do it. Sandeep, is the valuation done in multiples of revenue or EBITDA? That's a great question, Sandeep. So if you look at the traditional large companies, all there in the stock market, their multiples are on EBITDA, or what are the profits that they're making, and then an extrapolated view of that, which is called future cash flows, and then discounted to the current price, to the current day. Unfortunately, in tech, because there is no EBITDA, and it wouldn't be perhaps for a really long time, most of the valuation is done on revenue multiples. That's the only difference. So in private, most of the valuation is done on revenue multiples. In public, almost all the valuation is done on EBITDA. If there is no EBITDA, then of course it's done on revenue multiples. After all the series that are raised A to E, what happens if the company needs more money? You just keep going on. F, G, H, I, chalta rahega. It just never ends. It just keeps going on till the time you get an exit or an IPO. And that's how it works. Atul, that's a very interesting question. Can the investor be repaid and the founder can regain their percentage of shares? Technically, yes, but it's very expensive, right, Atul? Because imagine that if someone put in 25 lakhs at 1 crore and got 20% of the company, and let's say after 3 years, you're like, you know what, I want to buy you out and get this 20% back. They'd be like, I had promised a return of say 10% to my LPs or 20% to my LPs, which means I technically need about 42 lakhs from you in 3 years. So you will have to pay up 42 lakhs to get that 20% back. And it's possible that the company has those reserves, which is what happens when companies do something called company buybacks. What are company buybacks? And this happens only in public markets. The company has so much cash sitting in its accounts that it begins to buy back the shares in the public market because it believes that the value of that stock is a lot higher than at what price it is trading right now. So they're like, I can actually use the money to buy those shares and take it for the company. Thus, the company has a lot more ownership now, and there aren't too many shares in the public market. But in private, it just means a whole lot of capital, and most founders do not have that kind of capital. Nishant, what about an investor who wants to exit in the next round? Any investor that wants to exit in the next round have to do 2 things. One, they of course have to get to a point where there is an understanding from the next investor that whatever money will come to this investor will not go to the company. And remember, investors don't like that. They don't like money not going into the company because what is their objective of putting the money? Their objective of putting the money is to make the money grow the company, is to make the money deployed and to work to get the company to the next stage so that their return on capital is guaranteed. But if they give the money to an investor, that money is just wasted. So mostly this happens at a very late stage. It doesn't happen early on. If it does happen early on, then that understanding between the 2 investors that the money that I am asking for is money that will not go into the company is a very important understanding, both between the founders and the investors, because the founder would want all the money to come into the company because that is what will make the company work or run. Harshit, do you think startups can scale and grow while bootstrapping, or at some point of time funding becomes necessary to scale? Harshit, here's my honest admission. After having run bootstrap companies, which was my first company, and then having raised $43 million for Nearby, I feel that you can absolutely run a bootstrap company and make it a success without ever raising funding. I also feel that there are some businesses that cannot make do without funding. What are those? Those are typically very large businesses. And if you go back to the module of demand and supply, local and global, I don't know if you remember, but there was a quadrant in that which was local demand, local supply. A business that has its demand locally, so all the customers have to be acquired locally, and the supply, whatever it is that they're selling, is also local. Those are businesses that require a lot of capital because every new geography needs to be opened up from scratch. And that's why Ubers or cab driving, food delivery, nearby, these are businesses that are cash guzzling and do require funding at some point of time. But most software businesses, SaaS businesses, B2B businesses, they can be bootstrapped. And there's so many good examples of that. Wingify, Fusion Charts, BrowserStack, the Zohos of the world, even for that matter, Google, for that matter, Facebook. All these companies did not raise a lot of capital, but have built really large businesses just at the back of super solid software, super solid tech, and of course, great execution. Abhay, that answers your question. Example of successful businesses. If you want to, please go and research about Wingify. That's a Delhi-based startup. Go and research about BrowserStack. That is a Bombay-based startup. Go and research about Fusion Charts. That's a Kolkata-based startup. Zoho. That's a Chennai, I think, but they've moved their headquarters right now to someplace else. I'm not sure. That's a great success story. While it has raised a fair bit of money, but it has gone on to do much, much, much bigger than what it has raised. And these are just some examples that come to my mind. There are plenty of examples of businesses that have never raised money, not even a single dollar, and have gone on to become really big businesses. Ankit, thank you so much. There is a website called captable.io. Captable.io, which is a great website for coming up with the cap table. So you can use that. Thanks so much, Ankit. It's really nice of you. Pushpak, how does the CEO or co-founder salary work? Who determines it? That's a good question. So until the investment comes in, the CEO and the co-founder determines it. After that, the investor has some role to play in that. What do they want? They typically want that the salary should not be such that the founder is dying or is just always at a loss of money, but it also shouldn't be so big or so large that most of the precious money is going to paying the salary of the founder and not for running the company or making it grow. So it's some sort of a balance, and it usually happens, like my ballpark would be a co-founder would typically, for a funded company, take a salary which is 20 to 30% lesser than their market salary or what they would have got otherwise. That's usually the ballpark, but it could dramatically vary based on the conditions. If my investment is 60 lakhs, co-founded investment is 20 lakhs when we start, and we start with 50-50 split, how does a new share split work? So Gururaj, the question first that I have for you is, what is the pre-money valuation of this? Because the 60 lakhs and the 20 lakhs has to come at a certain base. Let's assume that that is 1 CR. Then the 60 and the 20, which is the 80 lakh investment, plus the 1 CR of pre-money makes the company now 1.8 CR. And you, for your 60 lakhs, will get 60 upon 180, which is 33%. Your co-founder for 20 will get 20 upon 180, which is 1/9 or about 11%. And the 50-50 that you had will get diluted by 80 upon 180, which is, say, about 45% or so. And that's how the math will work. Captable.io. Can the company valuation be devalued in the next round of series funding? Absolutely. That is what happens. That is exactly what happens. So think of it like a stock market. This is no different from a stock market. What does the stock market do? The share price goes up, goes down, goes up, goes down, goes up, goes down. So the only difference between a private and a public company is that the public company stock price is real time. You can literally see it, and at that point of time determine the value of the company. The private is very long feedback loops. You don't know what the real value of the company is. You will have to plot those curves over a very long period of time. But what you are discussing or talking or referring to is what's called a down round. And what's a down round? A down round is when the next round of funding is at a value which was lesser than the previous round. And that happens. It happens a lot. Most of the funding that is happening right now during COVID, especially for businesses that have been hit negatively because of COVID, are down rounds. These are companies that have run out of capital. Investors have put in a lot of money. So to save their investment, they have no choice but to put in more money, because they can't be like saying no to all that money and saying, okay, you know what, we've spent $10 million and now it's okay, we can see it written off. They have to put in some more money. But when they put in that money, it's now at a down round because revenues have plummeted, growth has plummeted, Sales has plummeted, so on. And they're like, we're now going to, for the same amount of money, get a higher ownership or bigger share in the company. And that is what happens. Nilesh, approximately what percentage growth is considered good growth in startup for seed or pre-series A? Usually the ballpark is at least 100% year on year. If it's very early, it should be almost 50 or 100% every month, because it has, of course, the base effect, right? So ballpark for seed is that you're absolutely growing 100% year on year. That's like the minimum base. Typically, most of the seed rounds will happen at growth rates of 300, 400% year on year. And of course, with the base, then the percentage keeps going down. Sanatan, is it okay to dilute equity for an angel round? Sanatan, that's your personal choice. Whenever you're raising money, you will have to dilute. So the question is, should you be raising an angel round or not? The best thing is raise from friends and family who don't really care about having an ownership, but just giving you the money to support you. That's the best kind of money. It may not be a lot of money, but then that will also then set you up for the discipline that you use that money wisely and you use it judiciously, and you don't just be flippant with it. You don't waste it on building a fancy office or doing anything like that you shouldn't be doing. But whenever you're raising a round, you're signing up for dilution. Simple as that. Divyanshu, can voting rights of shares be modified after raising one or more rounds? Usually not, Divyanshu, because typically when you are, like, it's possible. Let me start with that. It's legally possible, but practically it doesn't happen, because then all the investors will be like, hey, this is not cool, because we had signed up for this voting right and now suddenly you're changing it. So the only circumstance that will allow this to happen is if the company has done so well or is in such a strong position where it can say, I want this to happen, else I'm not going to do ABC or agree to XYZ, in which case the investors will have no choice but to agree. But mostly it doesn't happen. It's a very, very rare occurrence if the voting rights are changed. Omar, are both seats decided on an equity percentage? No, Omar. The both seats are typically one in odd numbers. So you need at least 2 board members. So usually a board is 3 people, but it could start with 2 as well. And the investors then come in. The usual ballpark is you don't give a board seat for less than 5 to 10%. So if anyone has less than 5 to 10%, then you don't give a board seat. Like that's too much for them to take. Like why should you give someone a board seat for just 5 to 10% equity? Typically, any investor that comes in and takes about 20% or so will take a board seat. And if they take majority, if they come to a point where they have more than 51%, then the board representation will have to be such that they have majority board seats. That doesn't mean that the number of board seats will be equal to the percentage ownership, but the majority will be reflected. So if it's, for instance, 51% investor and there are 7 board seats, the investor will have 4 of those. And that's how it would work. But that doesn't mean that 4 out of 7 is 51%. Samyak, how has Zerodha managed to not raise any money? Guess what? Because it's a profitable business. Every transaction that you make, it's the best business ever. And I love Zerodha. I've had the privilege of speaking with Nitin Kamath, who's the co-founder and CEO of Zerodha. Brilliant execution, unbelievable tenacity and perseverance. Here's the truth about Zerodha. You're selling shares, you have to pay. You're buying shares, you have to pay. Every time there is a transaction, Zerodha makes money. Every time. Of course, it's a free platform for retail investors, but retail investors are not the ones that comprise the bigger investors in this country. The bigger investors in the country are those bulk investors, which are not really retail customers like you and I, which are doing day tradings and are doing long-term investments and bulk investments of large quantums. And there, they charge a very small fee, but a fee nonetheless. And that just adds up to make all the profits. And it's a great product. So it's like a classic example of someone who's built a great product in a market that's super crowded and differentiated itself only on the basis of very smart pricing and absolutely focused attention on tech. I love Zerodha. I'm a Zerodha fan. Sujay, if the founder sells the company for less than the total amount raised, will the founder make any money? No, Sujay. As I said, this is where liquidation preference comes in. Liquidation preference means that the investors will first take out the capital that they have invested, and only after that will the remaining capital be shared amongst the owners. So if you sell the company for lesser amount than what you have raised, you're not going to make any money as a founder. Santosh, when a founder takes debt funding and say the company decides to shut down, since the loan is on the company, is the founder liable to pay back even after the startup fails? No, that's the definition of a private limited company. The private limited means that the liability is limited and the liability does not transfer to the owners of the company. In a LLP, which is a limited liability partnership, there it will happen. So it's a difference between what kind of a company do you set up. In a private limited company, the company takes the debt and there is no legal implication on the founder. Of course, there is emotional and social and psychological pressure on the founder. So the bank will not be like, oh yeah, it's the company, and if the company can't pay, we're cool with it. They're going to do whatever they can to get the company to pay. But legally, there isn't. Adiraj, can we calculate the share price at the post-money? No, the share price is always calculated at the pre-money because that's the core intrinsic value that has been determined. The investment that comes in just adds to make a new value. Astha, what's the normal vesting period for founders that investors ask for? So typically, Astha, what happens is a normal vesting period is 4 years. And this is for ESOPs. I'm not talking about founders right now. So for ESOPs, it's typically 4 years with a 1-year cliff, which means for the first 1 year, you're not going to get anything. Then you're going to get 25% at the end of the first year, and then you're going to get it for the rest of the years. For founders, usually, and this is for the best investors that work, the ones which are really founder friendly and do not come across as necessarily brutal, they'll say on the day of the signing itself, because you started the company, right? It's technically your company. So if you're imposing a vesting, here is how we will impose it. On the day of the signing of the deal, you'll get 25% right away. So there is no cliff. The cliff of 1 year is removed for a founder. You get 25% of your total equity on day one itself. And then over the next 3 years, you get the remaining 75%. That's usually the composition of a founder vesting. Ravi, some investors are there for the short haul while others for the long haul. How do you decide which ones are the right fit? Ravi, it's an important question, and the only way to determine that is to look at the investments that they've made beyond you. Those are the best references that you have. Like, think about when you're making a senior hire, how do you go about determining beyond the interview process whether the senior hire is good or not? You do reference checks, right? You speak to their ex-employees, you speak to their colleagues, and that's how you determine it. It's the same thing for an investor. When an investor is coming in and you don't know whether they're for the short haul or the long haul, what is it to deal with them as investors? How are they on a daily basis? You speak to their portfolio companies. You speak to founders who have already raised money from them, and they will give you a very good sense of how it works. And that's usually the process that one should take. Can someone ask company for sweat equity instead of ESOPs when joining as an employee? No, because the company will not issue it. The way that it works, Deepthi, is you want the employee to stay in the company for a long period of time, which is why you're issuing the ESOPs in the first place. So you will put up a 4-year vesting, and you will then give the equity every year for 4 years. With sweat equity, technically you're giving all that equity right up front. So the employee can just literally walk away the next day saying, thank you so much. It was very nice of you. I'm walking away with this equity. You wouldn't want that, right? So why would you do that? Nikesh, you know what? And it's funny you make this question, which is, can we get a bonus session on how to present your company to the investors? I was very tempted to do that, but I recognize that fundraising in itself is like this really broad thing. So I'll pick it up as a completely different course and give it its due attention. Because it's not just about presenting, it's about what does the term sheet mean, how do you really present, how do you pitch, how do you form those connections, how do you get in touch, what are the conversations like. There's a lot of detail, and I cannot possibly just cover it in one more session, and it'll take at least 2 or 3 more, and that's why. Zerodha is a great example for a bootstrap company, absolutely, couldn't agree more. Amit, in which situations can one take debt instead of equity? So you have to recognize this, Amit. For a company and for an individual, taking debt means the same thing, which means you will only be given debt if there is a surety or a guarantee that you can pay the debt back. So today, if I were to ask you, can you get a personal loan from a bank? And if the answer is yes, what determines that? Your salary, the consistency of your salary, the predictability of your salary, the amount of savings that you already have, what is the kind of quantum that you want to raise as a loan, how long will you take to give it back, what's the rate of interest, so on and so forth, right? And that's the same thing for a company. If a company wants to raise debt, there has to be surety that the debt can be paid back. So number one, a company that is not profitable will never be able to raise debt. Never. Because guess what? It doesn't even have money for its own existence. How will it pay back a debt? So a company that's losing money very rarely raises debt. They can raise something called venture debt, which is a completely different animal, and I'm not going to confuse you with that. But formal debt, which is the bank loans that we sign up for, that is not going to come to any company that is losing money. And then there is the predictability of that income, the consistency of that income, the quantum of that income. All of that is a determinant to whether you can raise the debt or not. Do angel investors generally get the voting rights? Aman, every investor, by virtue of them having an ownership in the company, will get in voting rights. So voting rights is not a choice. It's something that comes naturally and automatically with every ownership. The question is, what is the voting share that you have over and above the shares that you have? Is it 1:1? Is it 1:2? Is it 1:to something else? And that then determines what percentage of voting do you have or you enjoy. All right, this closes all the questions. Let's go through a quick wind up so that we know what all we covered today. We started with the concept of whether you should raise money in the first place or not. And there I went upon a monologue stressing upon the fact that investors are in the business of entering and exiting businesses. They're not in the business of making businesses work, which means when you raise money, even if you don't have any legal obligation to pay it back, you do have an implicit understanding that you will give a return on that money. And that means the way that it gets done is for you to continuously keep raising money so that the value of the asset, which is your company, keeps increasing, and thus the value of the ownership that the investor has keeps increasing. And eventually, you hope for an IPO or an exit, which is when the investor gets their money back. So it's not as easy, not as sexy, not as glamorous as you make it out to be. It's nearly not as much as what you see or read in the news. It is really hard. It's signing up for a lot. And that is a conversation you need to have with your own self. Do you want to participate in this journey or not? Once you do decide that, yeah, this is something that I would want to do, then the question is, when's the right time for you to raise money and what should that money be raised for? There, we shared a very simple, whether you're a tech company or not, and whether you are generating revenue or not framework. And depending on a yes or no, we went through 4 different instances of when you should be raising money and what should you be raising for. And then we finally spent a whole lot of time on how does the dynamics of fundraising work. And there, the simple formula that we started with is that every company has a valuation, which is called a pre-money valuation. You add the investment that it raises or the funds that it raises on top of it, and that becomes the post-money valuation. Through a framework of whether you're a tech company or not, whether you are generating revenue or not, and whether you're growing or not, we arrived at a framework or a guiding force to what the pre-money valuation could be. Depending on whether you're a tech company or a revenue generating company or a growing company, there are ballpark numbers of what the pre-money valuation for your business could be. And that is the starting point. Because then any investor will come in and say, hey, based on this pre-money valuation, I'm going to invest X rupees, X dollars into the company and thus get Y percentage. And everyone else in the company will then get diluted by that Y percentage. So if an investor puts in money so as to get 20% of the company, everyone else in the company so far, whether it's founders or any other investor, will get diluted by 20% of their current ownership. And that dilution is real. It happens really fast, it happens like nobody's business, and the next thing you know, you've gone through 3, 4, 5 rounds of funding, each one of them has diluted you by 20%, and now you're left with almost close to 10% or so, and that may seem like a lot lesser than what you think you deserve to own. In which case, this is a very important consideration. Is fundraising for me at all or not? Because in addition to dilution, there's also this concept of liquidation preference. And that is when a company is sold, first and foremost, the principal amount that all investors have put in is sent back to them. They get it back first. And then whatever is left is distributed amongst the shareholders. Which means that if you sell your company for lesser or round about the same as how much you've raised, you as a founder are not going to make any money. You as a founder are not going to see any money come out of that. And that is a big reality that you need to be aware of. How most young startups raise their equity. They are like, we don't know what the pre-money valuation is, so we're just going to raise this debt, and at some point of time, which is the next round, the pre-money valuation will be determined by a combination of the revenue we're making at that point of time, how fast we're growing, and so on. And that pre-money valuation will then determine at what price does this current debt that we have raised get converted, and thus what kind of ownership that they have. It's a fair bit to sign up. It's a fair bit to sign up as a founder. Whether to raise or not is possibly the biggest question you ask outside of who or whether I will have as a co-founder. That can determine whether the company succeeds or not. Because here's the last thing I want to share with you, and I want you all to listen carefully. No startup ever fails. No startup ever fails. What they fail in is to live up to the expectations that they had for themselves and that they sold to the investors. No startup ever fails. They only fail in delivering up to the expectations that they had set up for themselves and they had sold to the investors. Because if you sold the dream of becoming a $100 million company to your investors, but you ended up only becoming a $10 million company, that's not technically a failure because a $10 million company is still a big company, but you still would have failed because you sold the wrong expectations. And you would have raised the wrong amount of money. You would have diluted the wrong amount of equity. And by virtue, you will not be left with anything, and that will become the failure. It wouldn't be the fact that the business per se is failed. It's because how you went about the fundraising and the dreams and the expectations that you sold that led it to be classified as a failure. I'll see you all in the next module, which is going to now start the journey of building the first version of the product. In module 6 of the Future Founders Conference, we cover how do you go about building the first version of your product, also usually called the MVP or the minimal viable product. Thank you so much. God bless. Stay safe. I'll see you all soon.